All right, why don't we begin? Stephen, I believe I have you off of mute as well. So hello and welcome all to the latest Wall Street Blockchain Alliance member webinar. The Wall Street Blockchain Alliance is a not-for-profit trade association headquartered in New York City with a mission to guide and promote the comprehensive adoption of both blockchain technology and crypto assets across global markets. My name is Ron Quaranta, and I have the privilege of serving as chairman of the board of the WSBA. A little bit of housekeeping before we begin. This webinar will be recorded and all attendees will be in listen-only mode. We will reserve some time throughout Stephen's presentation for questions and answers, including some time at the end for Q&A. For all of those who have dialed in, please submit your questions via the Zoom chat function only. Questions for those folks who dialed in can be submitted afterwards, and Stephen and our colleagues will be happy to respond back as well. So let me take a little bit of time to say, offer a please welcome to our guest, Mr. Stephen Becker. Stephen is the President and Chief Operating Officer of the Maker Ecosystem Growth Foundation. Steve, I think I got that correct.
Perfect.
I'm going to stop sharing and let you share your screen and let you take it away.
Thank you very much. Let me get technology working for me. Give me 1 second. Okay, Ron, is that?
Yep.
Is that up?
Yep.
Okay, super. Well, wow, thank you. Well, hello everybody, and thank you very much for taking the time to join me today. I mean, it's certainly, quite a privilege to present to the members and associates of the Wall Street Blockchain Alliance. What we're going to do today is we're going to explore one of the most important aspects of the blockchain industry, that being stablecoins, and also specifically, we're going to have a look at the part MakerDAO plays with its decentralized stablecoin called DAI. But let's start with some introductions. So first, MakerDAO. MakerDAO is the combination of a protocol and a community that has created the first fully functional decentralized stablecoin called DAI. And importantly, it's a protocol that reflects the passion of making the global financial system accessible to everyone. Now, my name is Stephen Becker, and I'm the President and CEO of the Maker Ecosystem Growth Foundation, or just the Maker Foundation. And I emphasize this because a very important distinction needs to be made. That distinction is really between the Maker Foundation and MakerDAO, as they are not the same thing. MakerDAO is the combination of the Maker protocol that is on-chain, plus the Maker community that contributes to and operates that protocol. In fact, you can consider the foundation to be a super user within the community. And the reason we call ourselves a super user is that the foundation has given itself the task to facilitate the growth and acceptance of its stablecoin DAI, which is an important task because as you probably know and as you've probably seen, stablecoins have slowly started to get a lot of attention in the mainstream press. And there is really a massive value proposition in the use of stablecoins, so it's kind of vital that they're properly understood. And importantly, and really importantly, stablecoins derive the utility and value from public blockchains. So to maintain that value, it needs to inherit the characteristics of public blockchains and be accessible to absolutely everyone. But first, right from the beginning, what is a stablecoin? So a stablecoin is simply a cryptocurrency designed to minimize its price volatility relative to some asset or basket of assets. Now, two important points to note. I will come back to this definition again, but just for now, please consider these 2 points: minimizing price volatility and relative to some asset. And before we begin that, let's kind of remind ourselves what a blockchain is. And I'm aware, I really am aware, and I apologize for this, that most of us here today have a very firm understanding of what a blockchain is. But for the purpose of understanding stablecoins, let's use the following description. So when thinking of a blockchain, picture a spreadsheet that is duplicated thousands of times across a network of computers. Then imagine that this network is designed to regularly update the spreadsheet. I really like this definition. It seems to be the most intuitive one you can keep in your head. So the idea here is to think of it as a single spreadsheet duplicated throughout a network. So that's great. So let's get a quick intuitive idea of how this actually works. And like with every example I've ever seen in blockchain, there's always Alice and Bob. So let's use Alice and Bob again. So Alice wishes to transfer $4.25 to Bob. Very simple. Alice starts a transaction, which is basically represented by the inclusion of a third row into the spreadsheet that is closest to her. Now, if you think about that, that's very much representative of how someone starts a transaction and it first gets recorded in the node that's closest to them. Then when the blockchain updates itself, that particular transaction of Alice's is then replicated throughout the entire network. In other words, it basically updates every spreadsheet in that network. And then as a consequence, the update itself is then made available to Bob, because now Bob can tell from the spreadsheet closest to him that Alice has transferred $4.25 to him. Now, that is again quite representative of the fact that Bob would be able to tell from the node closest to him what his representative value is that has been transferred to him. But from their perspective, it's very simple. From their perspective, Alice and Bob simply just see a transfer of $4.25. They don't really see what happens in the background unless they're extremely proficient and they really want to. Generally, most folks just see the simple transfer. But I think immediately everybody on this call has seen the problem, and that problem is fairly obvious. The idea is wonderful and it works like a charm if we could actually transact dollars, but we simply can't. The only thing you can actually transfer on blockchain, everyone knows this, is convertible virtual currency. That's the strict definition as far as legislation is concerned, or crypto. But still, the idea of transferring dollars gives us the sort of direction that we should be tending towards anyway. So if we can only transact crypto, then we have a further problem. Well, nothing is actually priced in crypto. Last time I checked, Starbucks and Walmart have not started pricing their goods in Bitcoin. Although I must say that Walmart has threatened to launch its own stablecoin. It's starting to become a little bit of a fad nowadays. So that is really where crypto's problem is that really nothing is priced in it. So by default, we have to take crypto and price it against something else. And the thing that we price it against is the dollar. But against the dollar, we all know that crypto is volatile. And to understand this, it's pretty simple. Think of the dollar. Almost everything is priced in it. So it gives the sense of being stable. But from the vantage point of, let's say, the Kenyan shilling or the Argentine peso, the dollar looks really volatile. So, what do we do? Well, there are two solutions available to us. We can become like Bitcoin enthusiasts, otherwise known as, Bitcoin maximalists, who believe that everything will eventually be priced in Bitcoin. Or we can simply try and replicate that dollar transaction we saw at the beginning of this presentation and create a crypto that acts like a dollar, but on chain. So from my point of view, and from the point of view of the Maker Foundation, the former is certainly a better solution than the latter. Therefore, the solution to the problem is in fact stablecoins. So at this point, let's go back and revisit the definition of stablecoins again. So it's a cryptocurrency designed to minimize its price volatility relative to some asset or basket of assets. And at this point, I'd like to emphasize that the asset in question is the US dollar. Now, other currencies or assets could be used, but considering that the majority of things around the world are priced in US dollars, it only makes sense that we first actually use the dollar. So with that, we have an idea of what stable coins are, and at the same time, why we have them from a blockchain perspective. But what types of stable coins are there? And more importantly, why are there different types? So there's a couple of ways to describe the types of stable coins. I've seen numerous categorizations, but essentially they all come down to the same sort of categorization. Stable coins are either centralized or decentralized. Simply speaking, centralized stable coins work by sourcing its value from deposits. So you deposit $1 into a bank and you get a stable coin token worth $1. Decentralized stablecoins, on the other hand, generally source their value from on-chain collateral. In that, if you pledge $1.50 of on-chain collateral, you can get a stable coin token worth $1 with $1. But there are more important differences that you should be aware of. Centralized coins get their name from the central risk they create for their users. Depositing funds with an entity actually creates this counterparty risk. So what's interesting is that the source of value of the stablecoins from a central issuer comes from the creditworthiness of the issuer, not the deposits. So the credit risk of the issuer really is always in question. And because it's not transparent how the funds are used, they have a somewhat opaque risk profile. And as a consequence, centralized stablecoins generally substitute the US dollar. So essentially, you take a dollar out of commission in order to create a new stablecoin. Where with decentralized stablecoins, things are really different because it's created differently. There are no dollars locked up. There is no substitution, only the ability to generate further value on-chain that is essentially extending the use case of the dollar. And most importantly of all, the collateral that is used on-chain is transparently escrowed. You can see exactly what happens with that collateral. But I'd like to take a pause there for a moment and consider some questions before we go into having a look at where stable coins collectively work very well. So at that point, Ron, are there any questions? I'm just going to double check any. Hello, Ron, any questions, or shall I just continue? I think I'll just continue from this point, then we can try and have a look at questions at the end. So
You are
Stephen, can you hear me?
yes, I can hear you now.
Okay. Sorry, we had a little technical glitch. My apologies. You should be good.
Okay. Are there any questions at this point?
Let me check the chat. No questions at this point, but those of you who want to submit questions via Zoom chat, please feel free to do so now.
Okay, super. Then what I'll do is I'll carry on at the next juncture, next pause. We'll take on any and all questions at that point. So what I'd like to do right now is have a look at where stable coins work collectively well. Somewhere where everyone is used to a place where they function appropriately and are expected to function appropriately, and that is as a payments rail. So let's have a quick look at that. So a traditional payments rail is pretty simple. Alice goes to the shop with a credit or debit card and makes a purchase. And all that Alice and the merchant see is what really happens between the blue dashed lines. But where in fact, the transaction first goes to the acquiring bank. And now what I'm doing is I want to show you all the intermediaries, all the steps involved, because it's very important to also get a sense of the costs involved. So where the transaction first stops is at the acquiring bank. And that acquiring bank is the bank that holds the merchant account and is also possibly the processor. Next, the transaction goes to the card brand, so to connect the actual acquiring bank with the issuing bank. And obviously the issuing bank is the bank that issues the card that Alice is using. So the transaction is checked against the available credit line or funds availability, and if sufficient, the transaction is approved. So that's all great. Alice walks out of the shop with the goods, but the merchant has to wait approximately 2 business days before receiving their funds. So knowing that, let's have a look at the cost of the transaction. If you have a look at the cost of executing this transaction, we can see that the cost seems to average around 2% of the transaction value plus a 15-cent minimum fee. And I must place a caveat here, because the representation that I'm giving of 2% and 15 cents is more a median and not entirely a representation. And the reason I say that is because I found the cost varies tremendously depending on a vast number of factors. In fact, I would say that my estimation here may be a little bit of an underestimate. But be that as it may, let's stick with the 2% of transaction value plus a 15-cent minimum fee. So over and above that basic cost, you also get a chargeback fee. And now this is the fee that the merchant has to pay in the event that the acquiring bank has to pay back a charge to a customer. And this is a highly variable amount and is really dependent on the notional value of the chargeback. So together, you've got this somewhat fixed component of 2% of value plus 15 cents with a variable component of the chargeback. And this chargeback has the effect that for every $1 of fraudulent chargebacks, it costs the merchant about $2.40. So what if we move the payment rail on chain? And as we all know, and I'm sure we all do know on this particular forum, so please, I apologize for repeating something you already have knowledge of. The benefit of on-chain rails comes from the fact that execution and settlement happens at the same time. The benefit derives from the fact that operational risk of executing and settling at the same time is all but mitigated. Again, the dashed blue lines, as you can see on the graph, are all that Alice and the merchant sees. The rest of the graph shows what actually happens in the background. And what happens is simply, Alice starts a transaction from her wallet, recall the entry in a spreadsheet. The blockchain then updates and the value appears in the merchant's wallet. It's very simple. And for those of you that are a little bit sort of fuzzy on the idea of a wallet, just think of it as a banking application that you have on your mobile phone or the online banking site that you use to transfer money. It pretty much is the same thing. So this entire transaction costs on average about 13 cents, regardless of the size of the transaction. And I take that cost average from the Ethereum blockchain. Obviously, from other blockchains, it would differ markedly. But I'm thinking in terms of a broadly accepted a public blockchain. So mitigating almost all of the risk in the transaction gets rid of the majority of the fees charged in a normal payments rail. So if you consider all those fees that we saw before, they're pretty much all but gone. So therefore, the reduction in costs could easily be transferred to the consumer as a discounting price, making the merchant more competitive. In fact, the potential for savings is pretty tremendous. Now, in short, if you go from a normal payments rail, which costs quite a bit, straight to an on-chain rail, depending on the transaction size, it could be an enormous cost saving, with execution and settlement occurring at the same time, mitigating a lot of the operational risk. So essentially, what can we take away from this? We can take away the fact that centralized and decentralized stablecoins collectively can create a new, more efficient and cost-effective payments rail. But here's the kicker. Decentralized stablecoins can actually do a whole lot more. And the crux of a good decentralized stablecoin is that something well designed, like DAI, generates credit against collateral. And why this is so important is because that is really a basic tenet of a financial system. So let's use an analogy to see really how that works. So assume you have $15,000 worth of gold and you go to your bedroom or study and place that gold into your vault. Now, this is not an ordinary vault. It's actually a smart vault. The vault recognizes that there's $15,000 of gold in it, and it makes $10,000 of credit available to you. Then you draw $5,000 of cash and use it to go on a quick vacation. The catch is, to get the gold back out of the vault, you have to pay back the cash you used plus a fee. In the decentralized stablecoin world, the concept is exactly the same. But instead of gold, you use an on-chain asset. And in this particular example, we use Ether. So you transfer $15,000 of Ether into an on-chain smart vault. And that smart vault, in turn, generates 10,000 DAI that is pegged to the dollar. So the smart vault has created $10,000 of stablecoin value. And likewise, you can draw 5,000 DAI and transact with it as you see fit, like you normally would do. And whenever you're ready, you can simply return the DAI with the appropriate fee. If you wish to withdraw all your Ether, all the Ether collateralized from the smart vault, you need to ensure that all the DAI plus a fee has been returned. But in fact, you can also withdraw on a pro rata basis, depending on how much DAI credit remains in that smart vault. So in this example, I've used a very common cryptocurrency called Ether. But in fact, something very interesting, you can tokenize any asset and use it as collateral as long as there is a clear recourse to claim against it. So to reiterate, any asset can be tokenized as long as you can take the token and claim that asset. This is very important. In fact, it's this tenet that makes DAI so useful for supply chain finance. But before proceeding, I'm going to take another pause here to see if there are any other questions.
Yeah, we do have some questions coming in, Stephen. Thank you for that. So one question, something to set a little bit of context here for you, Stephen, as well, is that we have a fairly substantial number of accounting practices and professionals within the Wall Street Blockchain Alliance. Obviously, they're clearly interested in both blockchain and crypto assets broadly. We also have a global partnership with AICPA. So one of the questions coming out of that context is, how should stablecoins be valued for financial reporting? And what are your thoughts there? And can they have a discount or a premium against that reserve currency? And how would that work?
Well, it's actually a very good question. I mean, the first thing you would need to do is consider if the stablecoin comes from a centralized entity or decentralized entity. So obviously from a centralized entity, it very much just comes down to how that reserve has been valued. Where from a decentralized point of view, the best that you can do is literally use market value. So considering that the exchanges are so fragmented, I'd probably take a sort of weighted average of prices given at a certain point of reporting, regardless of how you wish to report, and then use that as a figure. So those are the two ways. The on-chain ability to audit is exceptionally good. Everything is transparent. You can literally see everything from the collateral amounts to the amount of DAI being drawn, absolutely everything. So that becomes super simple. But the not so easy part is really the value that you want to put on the actual stablecoin itself. And as I said before, you literally need to just take market prices and probably weigh that appropriately and use it at that snapshot of that point in time.
Great, thank you. One other question, and obviously Libra has been a topic of conversation across multiple working groups across the industry, and I think you might address it later in your presentation as well. Libra claims publicly that holders have no recourse against their reserve. So why do you say that they do, or what is that kind of dichotomy, and is it really a governance question?
Oh, that's actually quite interesting. So Libra is a centralized stablecoin. You basically the potential Libra stablecoin will derive its value from the reserve that is accumulated and controlled by a central entity. So what I'm talking about is, in a decentralized world, you need to be able to use collateral that allows you to have recourse to it. So for instance, if I want to tokenize treasury bonds, let's say I managed to do that successfully and I put those treasury bonds I make those treasury bonds available as a collateral type, then I can create a massive supply of DAI. But if for some reason the value of those treasury bonds decline against the amount of DAI that I've taken from the system, then what happens is the system shuts down that position. So in other words, it looks to liquidate the treasury bonds. Now, because I use treasury bonds, they're very liquid. You understand where to go to sell them. It becomes very simple that the recourse is take the auctioned off collateral, go to the treasury bond market where you may find it, and effectively sell it off. So that recourse is due to price discovery on the secondary market exchanges. But you may find that there are more complicated structures. Maybe there is an invoice, well, not an invoice, I'll show that to you in a second, but you may find that there's a leveraged loan that is a little bit bespoke, a little bit unique. If that is used as a collateral type, then you need to ensure that the recourse, once you get that asset in your hands, you can go and use the legal system. You can go and use the defined recourse path to be able to liquidate that leverage loan. So that's the most important aspect. And the reason I've used treasury bonds and leveraged loans is because I really want to show folks that the one is easy to liquidate, the other one isn't. So if there's something that is really difficult to liquidate, it's probably not a good idea to use it as collateral in the MakerDAO system.
Understood. Thank you, Stephen. So there are no further questions if you'd like to proceed.
Okay, fantastic. So as I basically mentioned before, we looked at what a stablecoin is, the different types of stablecoins, and we've also gone into the concept of how DAI is created, and the fact that DAI and the MakerDAO system is actually very useful because it does create this basic tenet of a financial system. And the one place that it is super useful is actually in supply chain finance. So let's have a look at supply chain finance, because as everybody knows, it's really all about cash or liquidity management. And the main artifact in supply chain finance is the invoice, and it's this invoice that really is of interest. So in general, supply chain finance works as follows. If you know this, again, apologies for repeating, but think of just a large corporation purchases goods from a smaller company. Then what follows is, number one, the goods are delivered along with the invoice. Let me just see if I can put the goods are delivered along with the invoice. The invoice is then returned to the small company marked as being approved with, for instance, a 90-day payments term. So what generally happens is that the smaller company requires liquidity, so it takes the approved invoice to a bank and gets funding on it. The smaller company may get, let's say, 95 cents on the dollar for that invoice, with the 5-cent discount representing the cost of finance. And then to unwrap this whole transaction, at the end, the large corporation pays the invoice in full to the bank, and the bank realizes the 5-cent gain from providing that finance. So I think everyone is quite used to that idea and has a good sense of it. But what we have here is just a couple of problems. Now, considering that supply chain finance is quite a well-established industry, I think it's not so much a case of it works or doesn't work. It's just a case that it has nuances and it has a couple of restrictions that will allow us to sort of dig into where blockchain becomes a lot more effective. So when we have a look at supply chain finance, we need to consider the following problems. The first one is the smaller company does not have many options in terms of financing costs, because the smaller company needs to work within the financial modes of the bank and large corporation. It's important that the bank and the large corporation has a relationship, which means that the company is somewhat captive to that financing. Again, it's not a problem because there is a certain amount of choice the small company can have with respect to which bank it chooses, but there's really not a lot of banks out there to choose from. So generally, the other aspect about this is the entire invoice is generally discounted, not just a part of it. So it doesn't allow the small company to manage their liquidity in the manner that they want. They may not need all the funding. In other words, they don't want to be exposed to all the costs of financing. They may only need a certain amount. And they would generally find that with a bank that is willing to discount the invoices, it's generally all or nothing. There are some exceptions, and obviously this is a well-developed industry, so there are some nuances on the back of it, but generally that's the structure. So what does it look like? Oh, excuse me a second, I just need to get technology under control. So even with this construct in hand, even understanding very clearly that the supply chain finance industry is well developed, you still need to wait a couple of days before the small company has to wait a couple of days before they actually get that funding. Now, there's an alternative to where the small company no longer requires a centralized intermediary and can actually manage the liquidity position right on chain. So we're going to have a look at this. Now, the process is pretty much the same, except the smaller company now has more and better options with respect to liquidity management. In this new process, the approved invoice is turned into a token and pledged as collateral on chain. So you got the normal situation where the large corporation purchases something from the small, the goods are delivered with the invoice, the large corporation approves the invoice with the payment terms, but here, those invoices are tokenized. They're created into a digital representation that can be used on chain. That is really the crux of the situation. So when the small company takes that newly formed on-chain collateral and pledges as collateral, it has DAI made available to it, and it can use that DAI for its working capital. And what is really important here is that the smaller company can use the amount of DAI that it requires. So it has a control over the cost element when it comes to using that DAI. And then what happens is when the small company is paid, it then takes that requisite cash, converts it, and returns it on chain, returns it to the on-chain vault to end the overall transaction. So in essence, what has happened is that the smaller company has created its own bespoke financial solution using the Maker protocol and DAI. So supply chain management and supply chain finance is the cornerstone of logistics around the world. And in fact, something very important is that the supply chain industry transacts around, I think the last time I checked was around about $60 trillion per year in value. But here's the really interesting fact. About $4 trillion in value is locked up in the payments term or liquidity settlement periods, or generally speaking, that payment moat, that financial moat that is created. But with MakerDAO and using invoices as collateral, that $4 trillion gets released with an almost immediate realization of its value on GDP. So from DEX rates, as you can see in the top right corner, we can use an example of a truck driver with a payload. So, once the driver has taken possession of a payload, he or she can use a mobile phone to check if an invoice has been approved. And if the invoice has been approved, then the driver could quite literally press a button to access DAI from that invoice immediately. And then that DAI would then be available to the driver to continue operating the truck continuously, obviously within the confines of the law. So I suspect that not many people know, but you generally find that trucks are parked on the side of the road or in compounds because the financing hasn't come through to make the truck operable again. And in this context, you create a continually operable truck. You can always have the truck in use and operating continuously. And generally at this juncture, I get a lot of people pushing back and saying, well, that's not very pragmatic. I mean, you can't expect the driver to work continuously. And I completely agree with that. But what it implies is something more, is that you need more drivers. You need new truck owner models. And all of this could be applied from an economic point of view and result in creating more jobs and obviously boosting GDP. So just from the ability to create continuity with the use of an asset, you have the ability to start looking at new paradigms of thinking when it comes to affecting your business, at least from a logistics point of view. Now, DEX Freight was a good example, but on a larger scale, you have TradeShift, one of the largest online markets for supply chain payments, and they've been backed by Goldman Sachs. We've partnered, or rather the Maker Foundation have partnered with them in order to figure out how to tokenize the invoices on their platform. And Centrifuge, on the other hand, are currently creating supply chain payment document processes to help bring the supply chain industry on chain. This is a reality, and it's actually happening right now. And talking about reality, I'd like to make a segue to a simple question. How many of you have used a stablecoin today? I suspect really not many, if none at all. So I think there's a really important question here, and that is, well, who are actually using stablecoins? So this slide gives you an idea of the sectors currently on-chain using or integrating stablecoins. The value of using blockchain technology is, it's becoming really obvious to a lot of people, and consequently, the need to generate an on-chain economy has become pressing. We've seen this because we've got, I'm trying to just think of the number, I can't think of the exact number, but it's over 200 projects and organizations that have integrated DAI. And there's another approximately 100 sitting in the queue waiting to integrate. And the one thing to note, this is not about blockchain substituting the traditional economy. This is about blockchain augmenting it. The greatest benefit from blockchain is to see the on-chain economy dovetail with the traditional one. working in tandem and working seamlessly. That is really important. But the one thing we got to do is take a step back and think clearly that when you do talk about businesses, there is always a group of folks that we cannot forget about, and that is the regulators. And I would say that this is possibly the first time in history that regulators are stakeholders, and regulators can move away from gatekeeping to being completely integrated stakeholders. But this obviously is going to take some time, because we need to work together to ensure that the current regulatory framework works with blockchain as much as possible to begin with. But in the future, regulators will be baked right into the system. Regulators will become integrated right into the cryptocurrency with the ability to proactively, this is very important, proactively stop transactions and users if they're not compliant. Now, to use futurism a little bit to the extreme, there is actually currently a way for regulators to integrate right into the cryptocurrency to ensure compliance without even knowing who the users are or what the details of the transaction are. Now, that is what zero knowledge proofs can offer. But to be honest, I think the distance from where we are to where we can possibly see this become a reality is quite far. But I'm quite confident that it'll come onto the radar and eventually be incorporated into their thinking. Now, finally, the most important group of people that will benefit from the positive impact of blockchain, and especially DAI, are the unbanked and underserved. And what I believe is that, when I say I, talking about the Maker Foundation, believes is that the stable coins drop the financial barriers and give the 2.5 billion people around the world that are unbanked and underserved the chance to actually participate in an accessible global financial system and improve their quality of living. So from a social development point of view, it truly gives credence to the idea of a rising tide lifts all boats. And from a governance standpoint, by intersecting blockchain with social and environmental governance, you create access to the financial grid, which in turn will create a boom in productivity. And it's a boom which the likes of which I don't think anyone could anticipate. And on the back of this, in fact, there are a couple of other things that we need to look out for and are going to become very interesting to keep in mind. The first is central bank digital currency. Now, there's plenty of research being done by central banks who are thinking about creating their own digital currency. And they're doing this because they've researched and they've come to the conclusion that there is a lot of positive benefits to creating a digital currency with respect to monetary policy transmission and monetary policy stability. And I think what we're going to find, and I think the Fed has already come out with an indication that there is a movement towards a central bank digital currency, but there are a couple of central bank players that wish to try and come out with fast payment systems first. And in the US, the Fed has indicated that fast payment systems may be introduced in 2023. And I find that interesting because it's going to spark off a race condition that is really going to see if stablecoins and cryptocurrency may beat the Fed to the application of a fast payment system. I've always been of the mind that fast payment systems will come out first, precede cryptocurrency as a payment trail, and then eventually move onto cryptocurrencies. But I'm now of the mindset that you might find that crypto might win that race. So the second thing to look out for is obviously security token offerings, or STOs. Now, a lot has been said about it. There's also this idea that STOs are just the evolution, whether good or bad, of ICOs. But from our standpoint, I think that security token offerings are the future of capital formation. No longer will you be constrained by the simple debt equity approach. You could structure tokens to map to specific rights or obligations within the organization. You could create varying exposures that investors would really love to purchase in order to diversify their portfolios or achieve an alternative risk-return profile. And then underlying all of this is the third point, the DeFi space, decentralized finance. But what I'd really prefer to call it is the transparent finance space, which is really rooted in the adoption of the adoption and acceptance of DAI and the Maker protocol. And this is where I'd like to really make an emphasis because it's really important. And as I mentioned previously, if blockchain technology is used appropriately, it should augment the traditional economy, not substitute it. It should innovate and create new possibilities, not just simply replicate what already exists on chain. It should provide access to allow a better quality of life, because ultimately, if it does not, then it's just another technology captured by vested interest and incumbents to monetize, I'd say, the most important thing you have, your privacy and your identity. And on that little bit of a bombshell, I'd like to say thank you very much. And I'm obviously open to taking any new questions.
Stephen, thank you very much. We have quite a queue of questions popping up and a wonderful presentation. I'd like to kick it off with the first question, which goes back to a slide earlier on in the supply chain flow that you'd shown. Yep, that one. Second one, yeah. And one of the things you noted there was that item number 3, tokenize and pledge. And we often hear in this space, and I think overly comfortable saying, well, we'll just tokenize it. I spend a little bit of time talking about that. That's not a simple thing, relatively speaking. Can you peel back a little bit of the detail and layers of item 3, tokenizing and pledging? And there's no insignificant number of technology folks here as well. If you could peel that back for a few moments, that'd be great.
Okay, so what I generally do with respect to this, and I sort of anticipated this, is I like to create this particular graph in a very simple way. There's a flaw in this graph, in this process, and I'm sure you already picked up on this. And the one flaw is, well, if the small company gets paid back, that basically means the collateral that you have pledged becomes worthless because you've effectively realized your value on that. So what happens there? So that's the one challenge. And what you generally find is that there is an entity that looks after firstly the tokenization of the asset, but also operates the asset. So if folks cast their mind back to the traditional world where you have a lot of operating entities that actually look after the execution of contracts and the execution of legal agreements and processes, well, that is an entity that's also needed here. But when you include that in, it sort of complicates the graph a bit more. So yes, well spotted. That's number 1. Number 2, to the actual aspect of tokenizing as well, like what does that digital representation actually look like? Are we creating, with respect to invoices, are these non-fungible tokens? Are these non-fungible tokens going to have the expected value that you require? Do they have a standardization which could be accepted as collateral? That's also another answer, another problem. But we've come up with a couple of solutions, one of which is, well, you could create, especially from an invoice point of view, you could create a portfolio of invoices that sit within an SPV, and the SPV could issue a digital representation of its equity. And then that could be used as collateral. But it also very much depends on the makeup. It also depends on the underlying risk management of the collection of invoices. And to that end as well, it's also dependent upon the size of these invoices. As an example, you may have a $20 million invoice. Would you be able to tokenize it by itself and issue it, or does it require a special purpose vehicle to issue a representative token of itself? There are various ways, and I'm not going to sugarcoat it. It is by all means not an easy process, and it's kind of complicated. But the one thing it does do is it sort of indicates to a lot of folks that, when you go to the New York Stock Exchange or whatever broker you use, and you purchase Apple stock, what you find is that you've got to go through a little bit of paperwork. You open up your front end, you go click, I want to buy Apple stock, and then bang, you've got Apple stock. But in fact, the Apple stock does not belong to you. The process behind actually acquiring the Apple stock is intense. There's so much that is on the background that is so detailed in terms of the operations that are hidden from you that it just seems that it's very simple just to buy Apple stock, where in fact it's not. The same principle is going to have to apply here. You're going to have an operator that looks at the ability to tokenize in terms of legally constructing a digital representation, and also the recourse against in case something goes wrong. So there are not only the technological issues with respect to what do you do, create an NFT or create a token that represents an SPV, all the way through to what does that legal representation look like? Where does your recourse come in? How do you actually affect that recourse and satisfy an outstanding a transaction? It is exciting because unraveling firstly getting to know what the problem is and then solving that problem, you start seeing a lot of other serious benefits that you can get from tokenizing invoices, but also tokenizing just real world assets. So that's quite a wall of words for an answer, but I certainly hope that helps.
Thank you, Stephen. It does. And I think the next question might actually be an extension a little bit of that recourse commentary you made, which was, and the question is, what happens if an invoice isn't paid and the company owing the money goes bankrupt? Does the coin holder have to go into the insolvency case? And I think that ties into law and governance a bit as well.
Yes, governance is extraordinarily important here. The one thing that you've noticed throughout my slideshow is that I've been talking about DAI, but I have not been talking about MKR, which is the other token that allows you to participate in the governance of the system. I just feel that, you know, once you get the sense of how to use DAI, you start getting these questions about, well, how does one go about choosing this? How does one go about defining what recourse looks like? What happens if you have certain edge cases? Where does this risk management reside? Who gets to decide on this, and how does it get implemented? And to that question, the answer is, well, if you hold MKR, which is the governance token, it really is up to you. And this opens up a whole new aspect of, well, if that's the case, what are we talking about in terms of actual governance? And is this a plutocracy which can be influenced? Is this representative democracy? Or is this some other sort of governance that you've created? And to that, the answer is we've created something called scientific governance, which allows us to contain what is being governed and allows us to rigorously define what these risks are that are inherent in the system, so that when you choose them, when you bring them on, you know how to control for them, including legal recourse.
Great. Thank you, Stephen. Shifting gears just a little bit, you had mentioned earlier that the envisioning of regulators as stakeholders, which as an organization, the WSBA agrees with as well. To the extent you can talk about it, are any regulators or have they expressed interest in integrating yet, and where are those conversations going? Can you share that with us?
Well, the part that I know of is they are aware of what blockchain can do. They are aware of how they can be incorporated into it. Regulators have actually been pretty insightful, more so than you would imagine. But the one thing that's interesting is the representatives from these various agencies, they know what's going on. They understand what's going on. They know what needs to be done. And to a certain point, they're very excited about it. But to a certain point, they have a massive responsibility on their shoulders to be able to take this behemoth freaking ship and try and turn it into a direction that incorporates the crypto world. And that's really where, things become very difficult for them. They clearly understand what needs to happen, but the tools available to them, well, they've got to think about how to apply those tools creatively or possibly create new tools. A very interesting, a very simple, but a very interesting point of an example here is if anyone thinks about the travel rule, if anyone thinks about what the Financial Actions Task Force is trying to accomplish throughout the world as well. I mean, how do you marry this to the blockchain? How do you get a semblance of identity, of understanding how KYC AML is applied appropriately? There's so much to this that we can start using, but we need to figure out where that start point is and not try and solve for the end point. So as a point that we made, I can tell you guys that about 6 months ago, we were invited by the Federal Reserve Board to present to them. And we did so. And it was very well received, if I don't mind saying that myself. And the one aspect that they really enjoyed was if you think about a protocol as an ocean, it's very hard to regulate an ocean, but it's very easy to regulate how people use that ocean. You can regulate the ships on the ocean. You can regulate what's being transported on those ships and how those ships are used. So if you think about any and all protocols as an ocean, and you start thinking about these walled gardens, these entities that are actually regulated, operating on those protocols, you can start using the current tools that we have with those entities. And as this whole industry develops, you should see a transition of the regulator being, instead of being a gatekeeper to these entities on the protocol, becoming integrated into those entities, and then eventually becoming integrated into the whole thing. And that's my little bit of futurism. How it's going to play out, I don't know, but I certainly hope that's the direction it'll take.
Wonderful, thank you. We still have several questions, and I want to be cognizant of time, Stephen.
Sure.
So I'll combine a couple of them. A couple of are very specifically related to DAI. The first one is, can you please explain the economic reasons behind the increase in the stability fee of DAI? And then as a follow-on to that, can you also give us an update on the implementation of multi-collateral DAI?
Sure, by all means. So the basic tenet of a stable coin is that it will retain its stability through the process of arbitrage. Simply put, if you have a look at DAI, what happens is if the price of DAI is above $1, you increase the supply of DAI. So in other words, what happens is folks come in and they pledge collateral, they draw out DAI, which is drawn out at $1 per DAI, and they can go into the market and sell it. And if they sell it and the price of DAI is, let's say, $1.05, they'll make effectively a 5-cent profit. Likewise, the other way around, if DAI is at 95 cents, the whole point is to pick up the DAI, close the CDP because close the outstanding DAI that's being used because that close will be done at $1. So you will pick something up at 95 cents and be able to close it at $1, therefore realizing the 5 cents. Again, when you have a look at centralized stablecoins, the same thing applies. You've got arbitrage that allows you to keep the value pegged at $1. So why the need for the stability fee? Well, the stability fee is kind of like a rate mechanism. In other words, it tends to speed that process up or slow that process down. So arbitrage from the traditional world, everyone probably thinks like high frequency traders, arbitrage, it literally is all about latency speed and how instantly you can make an arbitrage. I mean, if you think about everything from Renaissance technology to I think it's called Citadel. These guys, they get up in the morning, they press the button, and before the first minute is out, they've already arbitraged $1 billion worth of transactions. On-chain things are really a little bit slower because it's not about arbitraging instruments. It's about making an ecosystem, an economic system work. So the stability fee gives two things. It gives the ability to speed up or slow down that arbitrage, but also acts as an extra buffer to the risk management system within the MakerDAO protocol. I may be going a little bit into the weeds a bit here, but the premise here is pretty simple. You have a certain amount of over collateralization that you use that should mitigate a lot of the volatility that you see from a particular asset. So if you take Ether as an example, use 150% collateral. And the idea there is that that extra 50% will protect you against the swings in volatility of Ether. But from general risk management principles, you can't have that look after you all the time. So you need to have something that it's called economic capital, which really looks at extreme risks. And this is where the stability fee comes in. The stability fee caters for that. And that stability fee allows you to take into consideration a lot of things that you generally would find in the traditional world with respect to an interest rate, but strangely enough, it's not interest rate. So the stability fee has two main features. One, it allows you to accelerate or decelerate the arbitrage mechanism. And number two, it allows you to create an economic buffer, an economic risk buffer that is part of the broader risk management framework of the Maker protocol. I hope that answered that question.
Yes, thank you, Stephen. So we've only got a few minutes left, and I want to get to maybe one or two more questions. As you're probably aware, we have a not insignificant number of attorneys from around the world that are part of Wall Street Blockchain Alliance. So this next question clearly comes from one, particularly under US law, vendor claims and invoices are not considered securities. Thinking back to your model around invoicing and on-chain, if you turn the invoice into a coin or token, are you concerned that that changes things?
Yes, always. I mean, the one thing that is really important is also the transformation of an asset. I mean, if you think about the application of law to structured products, you start combining certain things together. What does it turn into? I mean, that's the most important aspect of really structured finance. And you take the concept and you have a look at what it does with respect to an invoice. You can actually extend that to something that I think is probably a little bit better known in this forum, and that is wrapped Bitcoin. I mean, is wrapped Bitcoin the same as Bitcoin? Generally speaking, most people would think, well, all you're doing is bridging from one blockchain to another. But in fact, from an asset point of view, you're changing the entire risk profile. And because you've changed the entire risk profile, does it still have that inherent characteristic of being a non-security? Again, I don't know. I really don't. But yes, it is a consideration that is always considered. And the outcome of it, I suppose the best way of describing it is every time you go about doing something that's innovative, you definitely have to have a slew of lawyers with you that give you a good sense of the right questions to ask, and then knowing which questions you will be able to answer and which ones will just remain unknown. And being cognizant of the fact that as the landscape, especially the regulatory landscape, changes, you might find, you get better answers to the questions you knew, but you might get actual answers to the questions you couldn't answer.
Great, thank you. And we'll make this the last question as we come up against the hour. And I think it might fall into the same category of considerations and concerns for future. Question was, how do stablecoins in the future potentially stand up to, for example, government-issued digital currency or digital tokens? And what happens if there are regulations that potentially require parties to only use government-issued tokens? What does that picture of the future look like to you?
Well, there's two aspects to this again. If you lump stablecoins into the centralized category, then yes, you've got a whole bunch of people beating up against each other and hitting heads. But if you think about that question in the concept of a decentralized stablecoin, it's kind of like the same as saying that there's going to be an order that says that Bitcoin blockchain has to be shut down. Well, that's nice, but it's kind of impossible to do. The same thing with a decentralized stablecoin. The accessibility of it is going to be very hard to shut down. I mean, you can certainly go after all the right people, but it's kind of like a Bitcoin blockchain. All it's doing is putting a layer on top of already a decentralized entity. From a central bank point of view, they will probably really like a decentralized stablecoin, because from a market making point of view, from a liquidity point of view, you kind of need a central entity that allows you to move from one stablecoin to the other. Because here's the simple concept. Let's say you have a look at Libra, right? Libra is worth $1. That's super. You have a look at Circle Coin, which is USDC. Circle Coin is worth $1. That's fantastic. But is Libra and is Circle Coin fungible with each other? And the answer is no. And that's where the whole thing falls down. So you need the central actor that allows people to get the sense of fungibility between each of these particular centralized coins. And that's where a decentralized coin like DAI works. And that's also why Maker as a protocol is something I would think central banks would start looking at and using as a premise for what they want to issue. There's two types of central bank digital coins. There's kind of like the private coin that they want to create that really just only settles between central banks. And then there's obviously the more general one that they want to use for funding and interacting with the banking system. So if they're going to do the one that is private for themselves, well, then it's not really going to bang its head up against any of the stable coins out there. But if it does become more general, then the centralized coins are going to be the ones that come into focus, because I think the central banks are going to default into a more decentralized state and ask the centralized coins to basically work with it. And the tenet of that is to look at a maker protocol and say, well, now that's a really good place to start. And they may look at it and go, we want to make our own, which is great. Or they may look at it and go, well, why don't we just use makers? So there's a potential for that. Maybe I got a little bit of, sort of bright lights in my eyes, but I think there's the possibility of that.
Great. Thank you, Stephen. So we're at the top of the hour, just slightly over. I suspect we can keep going for quite a while. Let's leave it there on behalf of the Wall Street Blockchain Alliance and our members. Stephen, thank you very much, and to all of the team at Maker. We hope to have you back again. Thank you very much.
Appreciate your time. Thank you very much, all.
Bye-bye, everyone.